Okay, so what we're going to start with here is we're going to look at something called the high-low method. What it does is it looks at the cost at the highest level of activity, and it looks at the cost at the lowest level of activity in a business. And what we're going to try to do is we're going to try to separate the costs of these businesses into, or rather the cost of the production for these months, into variable costs and their fixed cost components. Alright, so like I said, you're going to take, right, it's the high-low method. You're going to take the highest level of activity, which is 2,100 units here, and you're going to take the lowest level activity, which is October, at 750 units at the cost of $41,250. What you're going to do is you're going to take the difference between the two of them, the total cost. Alright, so you're going to take 61,500, this total cost, and the 41,250 in October. So 61,500, and darn, don't you hate it when you forget the other number? 61,500 and 41,250. The difference between these two costs, this was the cost, is $20,250. That was the difference in cost between the activities of these 2 months. Okay. Okay, I had to format it a little bit to make myself happy. Difference in the number of units produced. So, number of units produced. At the highest level of activity, the number of units that you produced was 2,100, and then you produced 750 in your lower activity. So 2,100 and 750. 2,100 units and 750 units. Alright, and the difference between the two of these was 1,350 units that you produced more in your higher level of activity. So what we're going to do is we're going to take the total cost divided the difference in the cost over the difference in the number of units, and divide the two of those by each other. And what you're going to come out with is you're going to come out with the variable cost per unit. Okay, so that is 20,250 divided by the 1,350. And what we've got here now is we've got a $15 variable cost per unit for each item that is made. Alright, so this is really your step 1 here. Your step 2 is now going to be figuring out how your total cost can be broken down and using this variable cost number. So what we're saying is for every unit we produced, we've got $15 worth of variable cost. So our total cost is equal to our variable cost times however many units are being produced, right? Because it's $15 a unit for however many units are being produced. So it's variable cost times 15 units plus just the fixed cost, right? Because the fixed cost doesn't change based on the number of units being produced. So what we do know is we do know the total cost. So we're going to go back to the problem, the information for a second, and you're going to pick either the high or the low. Alright, we've got to use one of the two numbers that we'd been working with before, whether it was August or October. I'll go with August and use the 2,100 units at $61,500. So what we do know is we do know the total cost. We know the total cost of making these products was $61,500. So our total cost is $61,500. I'll even give you a dollar sign so you remember that that's cost. And that's equal to the variable cost, which is $15 a unit, times 2,100 units that we made, plus the fixed cost. Alright, because what we're trying to determine is we're trying to determine what the fixed cost is. We already know the variable cost is $15 a unit. So you expand this out a little bit, and you've got 61,000. Oh, here I'm going to cheat. You've got 61,500 equals, hang on, equals 31,500, which is 15 times 2,100. 31,500. Again, this is dollars, plus a fixed cost. So if you subtract the 31,500 from both sides, what you're left with is $30,000, too many zeros, of fixed cost. Alright, so we've just successfully determined that you've got $30,000 worth of fixed cost and $15 worth of variable costs in this particular example. And here you go. In this business, that is your approximate variable cost and that is your approximate fixed costs using the high-low method. Now just to show you, this right here is doing exactly the same thing that I just did on the Excel sheet. Alright, coming up with a fixed cost of $30,000 using the highest level of activity. Well, it also works with the lowest level of activity if we'd chosen the lowest activity level month. It was 41,250 of costs, and it was 750 units that were produced. You still would have come up with a fixed cost of $30,000. Now you might wonder, why do we do this? What does this do for you? Well, what we can do is we can say, alright, well what happens if we produce more units in the following month, in November, because the last month we were looking at was October there. So let's say we're going to produce another 2,000 units of inventory in November. Well, can we estimate what the total cost will be for that month? Well, yeah, you can. Because the thing is we know the formula. We know total cost is equal to $15 per unit times the number of units, plus the fixed cost, which doesn't change based on the number of units you're producing. So let's say we're going to produce 2,000 units in November. You can estimate that your total cost for the month of December are going to be $60,000, which, as you can see, would be very helpful for planning purposes, because that is the point of managerial accounting, is planning and running your business. So having a good estimate of what the cost will be in the following month would be a wonderful planning tool to use. Oops. Okay, what we're going to be looking at now is something called cost volume profit analysis. What we're really looking at is we're looking at the relationships between, as it says here, selling prices, sales and production volume, cost, expenses, and profits. Okay, that sounds a little bit confusing, but we're going to break it down a little bit as we go along. What we do for the most part when we're analyzing cost is we look at the actual costs of the product and not really consider the fixed costs very much. And the reason we don't consider the fixed costs very much, you're going to hear me say this again in the future, and you're probably going to hear it again in future chapters, but we really don't consider the fixed costs in making a product because whether we're making a product that is very profitable or a product that maybe is not very profitable, if we're making it, let's say, in a warehouse space that happens to be very expensive, well, the warehouse space is a fixed cost. And if you're trying to decide if a product is profitable or not, you really don't want to take into account where the product is made, that fixed cost. That really doesn't have anything to do with the product itself, it just happens to be the location it's made in. So let's just say the warehouse you're using happens to have property taxes of $100,000 a year. Alright, and because you're making it maybe in central New Jersey, where, Bridgewater, New Jersey, where it happens to be very expensive, very high property taxes. Alright, so you're paying $100,000 a year for that fixed cost. Well, let's say we moved our business to the middle of Nebraska somewhere. Alright, and our property taxes are now down to $5,000. Well, if we're trying to decide if the product is profitable or not, we really shouldn't be considering those fixed costs like the factory property tax expenses, because it's not the product's fault that the business is choosing to make the product in New Jersey versus Nebraska. So you shouldn't penalize the product for that higher fixed cost. Okay, so I'm probably speaking a little bit over your head at this point, but this is something you're going to see as you go along. The idea is we're almost going to be ignoring fixed costs in all of the things that we're going to be doing. Okay, so contribution margin is one of the things you're going to be hearing about a lot. And you're going to be using it in a ton of different formulas throughout the next bunch of chapters. And contribution is really not very complicated. It's simply sales minus variable costs is your contribution margin. So let's say you're making a product and you're selling it for $10 and the variable cost to make that product are $3, then the contribution margin would be the $7 kind of profit that you'd make on it. Now again, you're not considering fixed costs at this point because fixed costs have nothing to do with the profitability of that product or the contribution margin of that product. So just to show you what that's going to look like, let's look at it with some numbers in it. So let's say you have sales, you sell 50,000 units of something at $20 a unit. All right, so your sales amount will be what? Oh, I hate doing this in my head, carrying zero. 100,000 or a million? Let's say $1 million. Let's see, am I right? Yes. $1 million is going to be my sales. But my variable costs per unit are going to be $12 a piece. So $12 a unit at 50,000 units, that's $600,000, right? So what that's going to look like here when we do a contribution margin income statement, because this is what we're going to be looking at as a managerial accountant, is we're trying to look at the contribution margin. How is the product itself doing, not considering the fixed costs of the property taxes, not considering the fixed costs of the plant manager's salary. We're going to be looking at it by itself. So here you've got $1 million minus $600,000 in costs. That product is making for you $400,000. Minus your fixed costs of $300,000 gives you income from operations of $100,000. Now, the important thing to notice here is, what if my fixed costs were lower? All right. The point is that the product itself is making me $400,000. That's really the key point here.